Hello, everyone, and welcome to the Meet the Visionaries podcast, brought to you by the MIT Center for Real Estate. My name is Michael Khamis. I'm a student in the Master of Science in Real Estate Development program here at MIT. On today's episode, I have the distinct pleasure of welcoming Evan Reagan-Levine in person. Evan is the Chief Strategy Officer at JBG Smith, where he is actively involved in shaping the company's long-term strategic planning, capital raising, special projects, and analytics. JBG Smith, ticker JBGS, is a publicly traded real estate investment trust and one of the most influential developers and owners in the Washington, D.C. region. The company controls millions of square feet of office, residential, and retail space in a robust development pipeline focused on transit-oriented, mixed-use submarkets. JBG Smith is best known for transforming National Landing, home to Amazon's headquarters 2 and Virginia Tech's Innovation Campus, from a moribund office park environment into a vibrant mixed-use neighborhood enabled by physical and digital placemaking at the intersection of national security and technology. Before becoming Chief Strategy Officer, Evan joined the JBG Companies, the predecessor to JBG Smith, in 2013. He is a voting member of JBG Smith's investment committee. Evan began his career at JLL in research and market analytics, advising major real estate investors and occupiers on location strategy and market intelligence, and later worked as an associate at Monday Properties. He graduated magna cum laude from Georgetown University, where he studied government. Evan is widely recognized for his forward-thinking approach to real estate strategy, technology integration, and capital markets positioning, helping JBG Smith make and win contrarian bets and adapt to market shifts. Evan, we're delighted to have you in person here at the MIT Center for Real Estate. Thank you for making the trip up.
Thanks so much for having me.
Absolutely. So Evan, you have a very unique role at the intersection of strategy, data, and innovation, a position most REITs don't have. How do you think this differentiates JBG Smith from its competitors, and how does that translate into value for your shareholders?
So I actually think a lot of REITs do have a position something like this, but it might not have a name or a title in the same way that mine does. And so I think that when you look across a lot of REITs that do different things, and ours is a little bit special, a little bit different because we are so focused on mixing uses, that kind of role is important because you have to knit together different verticals within the company. So you mentioned Amazon HQ2. Well, that's a project that spanned our development and construction teams. It involved our office leasing, asset management groups. It involved our investments team, the team I sit in internally. And so being able to work on a project like that really involved knitting together all those functions, but also bringing along our support groups like marketing and IT. And so a role like mine, it exists in different ways and in different people inside different companies. But really the goal is to help for those kinds of special projects, those larger pursuits, bring to bear all the different components of our company. And you can see that sort of in a lot of different ways. But that's what it really is and what it's kind of set up to do.
That's fantastic. And we've kind of talked about already one of your most prominent projects, National Landing. It's received a lot of attention over the past few years as it's the site for Amazon headquarters 2. But National Landing is so much more than just Amazon HQ2. JBG Smith has established a diversified mix of anchor tenants, layered in a thoughtful mix of retail, residential, and office, and leveraged transit connectivity and placemaking to create a true innovation district. When you think about building something like that, how do you manage the interdependencies between the critical pieces that make it unique and sequence them in a way that creates long-term place value while also meeting short-term performance expectations as a publicly traded company?
It's a great question. Lots of different things layered in there, so I'll try and answer it in a few different ways. But starting at the most fundamental level, it's impossible to do a project like National Landing without scale and control. Mm-hmm. Everything started for us with the ability to get control of basically the entire submarket. So, we had owned buildings, one-off buildings in that submarket in the past. And, I think what you saw was that put you at the mercy of broader market forces, but also what the sort of master developer, in this case was Vornado, was really doing. And so what we learned in our experience, even leading up to National Landing, was that the places we could make the most impact and have the most control, whether that was being the majority developer along 14th Street and U Street, a kind of big emerging corridor in DC, or the Ballpark District at the Navy Yard, or those were places where we sort of agglomerated a lot of scale. And that gave us control, and it let us make decisions that weren't motivated solely by the return of that individual decision. So to use an example, when you talk about this, it links back to that kind of performance question. When you own thousands of apartment units and millions of square feet of office, we can kind of dig into that in a little bit, what you figure out very quickly is that some decisions you want to make are going to be loss leaders. It's going to be putting in, the neighborhood coffee shop instead of Starbucks. It's going to be making a decision on, selecting some, not only retail tenancy, but improving public space. Those are things that on their own, they would produce a terrible return. You wouldn't do them, but you do them because you own so much around that you can believe in a broader uplift. And so much of what we've done, whether it was that retail piece or doing things like a recent project where we've added a large scale, true conference center, convention center amenity that's serviced by F&B. These are things that we think generate a great return. We think that a lot of our thesis has been proved out, and that's been proven by our leasing performance on the commercial side, but also by the fast lease up and success from a rental rate perspective of our multifamily product. All of that is enabled by those strategic decisions you have to make early. All of that comes back to scale and control.
And one of the anchor tenants of note is Virginia Tech. In the past, you've mentioned specifically how JBG Smith, at the onset of National Landing, really eyed a higher education partner for National Landing. Can you speak to the value that the Virginia Tech Innovation Campus brings to National Landing?
Sure. So, when we first got control of the National Landing submarket, which is three pieces. It's Crystal City, Pentagon City, and Potomac Yard. They're kind of three interdependent pieces. And contrary to public thought and myth, we didn't come up with the name National Landing. It was actually something that was conceived by a coalition of economic developers who were chasing the Amazon deal. And it's impossible to separate the Virginia Tech and Amazon deals because they happened really as one. But when we just started, like at the outset, we thought that what's our big anchor going to be here? We have the Pentagon, which is a huge anchor. We'll talk a lot about that. But when we were trying to bring Amazon in, one of the things that they identified really early was that, hey, every other city we're looking at, the only thing you're missing, you have transit, you have talent, you have housing. We believe in your plan to remake this sort of strange office park on the Potomac. What you don't have is a major research university. And we had sort of thought the same thing. That was the kind of thing we were chasing. But it's hard to get a university to make a decision without a catalyst like that. And so for us, bringing Virginia Tech in did a couple things. One, it cemented that talent pipeline. When you think about their goal of producing close to 700 STEM graduates annually, focus on master's and PhD. So that means tech transfer, that means research. It doesn't just mean a pipeline for hiring. And their focus that adapted really well to the needs of our big tenants. And we think about ourselves a lot of times, and we'll talk about this, as being, to borrow a term from right here in Cambridge, the Kendall Square of defense tech. And so when you have life sciences up here, it's because you have life sciences, you have technology companies, you have major research universities. We had the big companies in terms of all the big defense primes. We had a lot of the innovative companies who orbited around them. We had the big customer in terms of the federal government. We were missing that research university piece. And so when Amazon made the, sort of the conversation about, we're thinking about this market, we want to shape our incentives, we partnered with the state to really figure out a way to drive Virginia Tech closer into the site. And in that case, it meant working with our partners, who is a JP Morgan advised private pension fund, to create a really, really good deal for Virginia Tech to come into the project, because we knew they would become this anchor for innovation, talent production, and would ultimately drive more tenants into our office and residential portfolio.
And it keeps talent in the DC area. We have so many great universities in the area. Not to name them all, but we have GW, I'll name first because I'm an alum of GW. But we have Georgetown. Virginia Tech, you can say, is in the area. Catholic, American, and a lot of the folks that go to those universities end up leaving the DC area to go to New York or other major cities. Is it the intent of JBG Smith to kind of keep that hub of talent here in the DC area?
I think that actually comes from a different place, which is that when people leave the market, and we talk about the tech drain all the time, and I would throw into your list, really thinking about schools like George Mason, the University of Maryland. I'm a Georgetown alum. I'm a proud Georgetown alum. We're a great school. We train policy wonks. We train, attorneys and ambassadors and McKinsey consultants. We don't train hardcore engineers. There's no real Georgetown engineering program like that. But the DC region does a really good job. There are a lot of schools that have really good, strong engineering programs. Those people leave because there's not a job for them. And so if I were to look at Amazon and Virginia Tech, we want Virginia Tech to be that kind of missing piece of yet another big engineering school that does a lot of research. And they, we're up here in a more scattered way. So to try and concentrate them and do something intentional makes a lot of sense. But to me, we lose those people not because we don't produce them and VT helps produce them. It's because we don't retain them. And that's what Amazon actually looked at that as a positive. And a number of other companies do too, because in other markets, they have to import that talent. Mm-hmm. They have to fight to bring them from a city where they're trained to a city where they'll live. And in this case, I think what was really exciting was Amazon, but also the rise of this national security technology field has provided a lot of job opportunities in those areas where if you didn't want to work for the federal government or candidly for sort of an old school contractor, you wouldn't have been as interested in staying in the area. Creating this innovation district, we think that's the area where there's going to be a lot of intention around retention of that talent.
Makes a lot of sense. And prior to National Landing, Crystal City was largely a collection of lifeless offices Distressed retail, underutilized public space. I think we refer to it as moribund office parks, which is very accurate. Today, it's been completely transformed. How do you find the balance between meeting the demand for your anchor tenants on the office side while also staying true to JBG Smith's development philosophy of transforming properties into places?
I think that it's all a question of denominator. And so when we talk about it a lot, we really like to use the phrase, we're shrinking the denominator of office. I think, COVID was a massive demand shift on the office side. It was a shock to the system, but COVID wasn't the first time that had happened. And I think we were lucky in a lot of ways where when we came to Crystal City, it looked a lot like the rest of the world did after COVID, which meant that it had had a demand shock. In this case, it was the Base Realignment and Closure Act, where the government basically said, hey, we're going to take military folks, DoD folks, now I guess Department of War, out of their leased buildings and move them onto owned military bases or facilities. And that gutted a lot of what happened in Crystal City. And before that, it was patent and trademark. There's a long history, but effectively, it had seen this massive reduction in demand that was engineered by the government in this case, but it created a shock to the system. And that shock creates opportunity. And that's a lot of what we looked at and we saw there. But it meant reimagining the space and understanding that you probably aren't going to have the same level of demand as you've had historically. And by the way, that's what's going on in the broader office market right now. I think you have to have a realization that there just isn't as much demand. So how do you reduce that denominator so that with a fixed level of new demand, you can get supply and demand to the right levels where you actually have a little bit of pressure on inventory instead of a lot of excess inventory. And so a lot of what you've seen us do was selectively take buildings offline that were functionally obsolete, take tenants out of those buildings and move them to create a market that at the same time, by then redeveloping those old office buildings into residential or hotel or retail, you change the place. So now you have a place that's transformed with less competitive office inventory that then is more appealing to outside tenants to move in. And we have demand tailwinds from Virginia Tech, from Amazon, from the Pentagon. You have those things all combined. What we were trying to engineer was scarcity at the end of the day. And I think that's where we could engineer scarcity and improve the place at the same time. That was the goal of our thinking when we set out. It wasn't to try and somehow stimulate massive amounts of more office demand, because that isn't what's happened. Mm-hmm. What's happened instead is we found creative ways to get better rated office demand, better quality office demand into a smaller universe of inventory.
And what lessons from National Landing's evolution would you share with others trying to move beyond that single anchor tenant approach to building a more dynamic mixed-use ecosystem? That's JBG Smith's MO from day one.
Look, I think you can wait a long time for a big anchor. And we were lucky, and in some ways it's sort of hard to talk about this because Amazon, it's better to be lucky than good. And Amazon's RFP landed on our desks in late 17, early 18. We completed our merger in July of 2017. So it was we took it over. We had a plan that we were working out. And that plan didn't revolve around an anchor. What's interesting is while we lucked out on that front and that anchor was able to come into the space, what was a little bit different and I think interesting is that our plan didn't rely on that. Sure, we wanted to go get a university, but our plan really involved taking office buildings offline, bringing more people onto the street, improving transit access, doing all the stuff that made the place desirable, knowing that we might not get one big anchor, but we could get a lot of smaller ones. And that's back to that initial point. If I had one building there, I couldn't do that. I would not go and just preemptively improve that. It's a great way to light a lot of money on fire. It was because we had that scale and control that we could start to think about that. So when I give pieces of advice, it's, think about realistically what a transformation will look like. Don't try and transform sometimes a single asset without some kind of tailwind unless you can control more than that asset. Even if it's just an office building park with 2 or 3 other buildings where you can control your supply, where you can transform the environment, it's hard to do at kind of a tiny building by building level, but it's also something where you could be stuck waiting for a long time for anchors. And I can't tell you, if you go on CoStar or talk to a tenant broker, landlord brokers, whoever you want to talk to, there are a million different buildings that could be corporate headquarters site locations that have lost their anchor tenant. Guess what? That anchor tenant is probably never coming back and you're never going to backfill that building. So how do you start to get really creative about sort of the broader environment, what that can be a part of? It's hard to just sit and wait on an anchor because that anchor probably won't come.
Right. Making it a place that people want to be, where they want to work, where they want to live, where they want to play, creating that experience.
And you can't do that as a developer. You can't do that alone. That's something that you have to have strong municipal cooperation. It goes beyond, and this is why you can overcome some of the scale challenges, is be part of something. Like in Arlington, there's a great fast track process that the county, I think, has been really forward thinking about doing and delivering that's all around commercial resiliency. They want to shrink the denominator of their office products, so they've created an incentivized program in terms of not dollars per se, but dollars and time are always translatable one to the other, to speed up the process of entitling and approving, whether it's office, redevelopments or conversions, it's important to be a part of a program like that because that can help affect the scale, even without you as one developer having the scale. So being able to be smart about where you're making your bets and doing it in the path of those broader municipal incentives can help offset scale, because you want to be in a place where the overall denominator is shrinking, and we're going to see that transformation even if you can't do it all on your own balance sheet.
Can you share a little bit about how the jurisdictions were during this entitlements process? Seems that everything moved pretty quickly, smoothly, efficiently. That's probably a testament to both you and...
I think that what's so interesting about this is when one of the things that attracted us to the opportunity, and it was widespread, right? It was part of a larger merger discussion that involved a lot of different assets on both the JBG companies side as, private fund managers, and Vornado's side. But what I think was so fascinating about this kind of chunk in Crystal City was that there was an in-place Crystal City sector plan. And while it wasn't perfect, it had some really favorable zoning components to it, a lot of flexibility built in. And credit to Vornado, they worked for a long time with the county to help shape that. Without that certainty of entitlement, it'd be really hard to do this. And, a great example right now, and I'm hoping it'll be a similar success story over time, but is, we've all read about the federal government looking to divest owned assets. And for a lot of reasons, that actually makes a lot of sense. There's a huge maintenance backlog. It's hard for the federal government to appropriate money to properly maintain some of these buildings. It doesn't give them a lot of flexibility, but it doesn't change the fact that a massive swath of DC and even some big parts of other cities are going to be disposed of by the federal government. And the process already started. How jurisdictions react to zoning that, to coming up with a plan, the hallmarks of sort of flexibility and speed allow the market to adapt to that change. And that's something that I think the jurisdiction in Arlington did really well. And they've doubled down on that in terms of now putting in place some provisions and a program that can speed the redevelopment of an asset class that really needs to get smaller for them.
National Landing is shaping up to be one of the country's first truly connected districts. From fiber and 5G to edge computing, JBG Smith has invested a great deal of resources in building out the digital backbone to support it. From a developer's perspective, how do you figure out what emerging technologies to plan for? And how do you make sure that backbone stays relevant as AI, the Internet of Things, mixed reality continue to evolve over time?
So like anything else, and I've got a research background, so this one sort of comes easy to me in a way. We go and we talk to our tenants. We want to know what they care about. And so when we, really started to, in earnest, figure out what to do with National Landing, we talked to a lot of tenants, we talked to a lot of their brokers, and we'd hear that talent mattered a lot, but second only to talent, they said, we really care about our connectivity, our infrastructure. Yeah. And I think it's easy for developers and investors to get hung up on flashy, exciting technology. And that generally is another great way. I wish I would write a book about just like ways developers like to lose money. And that's one way to do it, because people get hoodwinked by this like flashbang idea of, well, there's going to be this seamless environment and everyone's going to have every device that talks to each other. Well, guess what? Real estate guys aren't the ones to do that. They're smart people. Exactly. We figured that out. So what we figured out was, what do we have? It comes back to that scale and control position. It came back to the fact that we were opening up the ground. We're building a lot of buildings. So we said, well, what is an impediment to delivering really good connectivity? And that was it's basically the pipes and the rails. It's the boring stuff. It's the unsexy stuff. It's making sure that there's enough capacity in the ground for fiber optics that can serve all the buildings so that every building can be fiber connected. And then saying, how do we make it super resilient? Because you think of the kinds of customers we have defense contractors and technology companies, people who want uptime, they want redundancy, they want reliability. And it's also a realization that we shouldn't be the ones providing service. Like our intuitive view was, look, we're not technologists. We can't set things up. We can't run things. I don't want to be in that business. But what I am is a builder. And so what we could do and what we did was partner with AT&T to say, well, if you want to roll out millimeter wave 5G, the fastest 5G, the thing people get excited about and talk about it, for IoT and massive device density and things like that, we basically allowed them to have a blanket contract to hang small cells off of all of our buildings. And we partnered with the county to do that, and we speeded the approval process. Now, the fiber that we put in the ground when the ground was open to do development and other projects, we were able to use that same fiber to serve it. So suddenly, someone else who's a real service provider, AT&T in this case, could roll out their upgraded technology faster because they could ride on our rails. Mm-hmm. But we built what we knew, and then we invited others in to build what they knew. And so doing things like that was answering that question from our tenants of, hey, can we have this better connectivity without us being in that service provider role? And we sort of think about that, and we can come back and talk about this, but with other amenities throughout the market, it's always, what can we cause to be delivered versus what do we have to deliver ourselves, and what choices can we make to enable that. And those investments will never be, big money makers for us, but what they do is they help our tenants and they pay for themselves, which is important.
Right. And looking forward, what do you see as the biggest unlocks or risks of trying to integrate smart city technology and infrastructure into a traditional REIT portfolio?
I think the REIT market likes things to be simple. They want to go buy a data center company. They want to buy a tower company. They want to buy an apartment company. So I think it was never going to be something that we wanted to move away. And we're a little different already by being a mixed use REIT. So what we wanted to do was just view everything that we did on that lens through sort of the view of tenant enhancements. And so if we could enhance it, if we could make it better for our tenants, we would do it. But it always, at the end of the day, came back to that sort of, you're not changing what kind of REIT we are. We're still office and multifamily. Right. We just build the best kind of office or multifamily, just like we're not a retail REIT, but we have retail in the base of all of our buildings. And we want to create a really good retail environment. So we'll do the same thing on the digital side. And that's the unlock, is being able to say, just add something to say, hey, there's a great restaurant nearby. There's a great hotel. That's a good example. We can talk about this. We are causing a hotel to be developed by basically doing a deal for a conversion of an old office building. And we're doing that because our tenants want better hotels in the market. We're not an owner-operator of hotels. It's not our business. It's not what we know. It's not what we do well. We're not a hotel REIT. We're not host. Mm-hmm. So how do we go find the right capital and the right operator to go do that? Well, it's by engineering the right kind of disposition in a way that's encouraging sort of the development of that hotel, just like going and signing the best restaurant or the best soft goods retailer. Think of technology the same way. It's the same kind of unlock. It's the same kind of structure. It doesn't change who we are. The risk that I'll tell you, and I've seen this, is people just get really excited about prop tech. And we're investors in prop tech funds. We like this stuff. We're interested in it. We follow it. We, I think, have the best management team, and I'm biased, but I think the best management team is forward thinking, but they're also discerning. They know what's just nonsense. And there is a lot of stuff out there that fundamentally hasn't altered the cost or experience of running or operating a building. And I think it's easy to get caught up on visions of what it can do, but it's harder to implement in the built environment. And so you have to be super selective so you don't waste a lot of time and money and end up delivering an experience that doesn't really matter. Like, do you care if you can order Uber through your tenant app or just do it on your phone? You'd rather just order Uber through Uber. So think about it before you do it, and don't get hung up on this vision that's very, very hard to deliver.
Yeah. So well put. Evan, I could talk about national lending all day, but we'll transition a bit. There's been a lot of exciting news of late about the adaptive reuse projects in JBG Smith's pipeline. In National Landing alone, between 2200 Crystal Drive and 1800 and 1901 Bell Street, we have more than 500 units of multifamily under development. At 2100 Crystal Drive, you're adding a 344-key hotel, which you just alluded to. With your recent acquisition of Tyson's Dulles Plaza in Tysons, Virginia, it's clear your footprint for these kinds of conversions is expanding beyond National Landing. How do these adaptive reuse initiatives fit into JBG Smith's broader strategy? Are they primarily a response to evolving office demand, or are they part of a larger play to reposition your portfolio to a more diversified and resilient mix of uses?
I think, I'd start with, and I'll echo, George Sanders, my partner, is our chief investment officer, who, it's all about capital allocation. And so if you follow us and you watch us, whether it's through our, private days, whether it was when we were syndicating deals or whether we managed closed-end funds all the way up till now as a public company, we've always tried to basically make our money on capital allocation decisions and being smart about that. And so we ultimately exit assets or even asset classes when we think they're, priced to perfection. And so there are times, and you saw us, we exited a lot of office buildings leading up to COVID and even almost immediately following. And we're getting back into that space because it's inexpensive and there's an opportunity there. And it took us a long time. It's been 13 years since we bought an office building, but we're buying office now because office is affordable and it's at a price that gives us the flexibility to deploy a lot of different strategies. And so when you follow us, we're trying to make decisions on what's the right move to generate, ultimately in a public context, growth in net asset value. We want to make the right decisions for the real estate. And so we're underwriting all these deals and understanding if I'm not selling it, I'm buying it. And what's my alternative if I'm buying? Mm-hmm. So if I'm, not selling a multifamily building, it means that I'm buying it. And would I rather buy that multifamily building or would I rather buy an office opportunity? And historically, it would be, we would have bought the multifamily opportunity. We would have held it. And that's a lot of what we did. And we transitioned our portfolio to be effectively 50-50 office and multifamily, which was our goal. with most of the office concentrated in National Landing. I think what you're seeing now, what's enabling these opportunities, is there's a generational repricing of office that puts office at a basis at which you have the flexibility to do a variety of different business plans. And it doesn't trap you into having to believe that every single thing goes right in your underwriting, that you were super smart, but everything you did on the office side, and you have this perfect exit. That was something that we weren't comfortable with. But I think now you could, be wrong about certain things. You could have flexibility and still ultimately feel really good about your basis.
It's great context there. And that almost answers my next question. We talked about in our introduction about how JBG Smith makes contrarian bets and adapts to market shifts. And I don't think that there's a better word to describe your strategy and your bets on office to resi conversions than contrarian. So many people have this perception that they're very cost prohibitive, they're risky, if you don't know what you're doing, you really can lose a lot of money. What does JBG Smith see here, and how are you finding value in these projects? You kind of spoke to that a little bit about the distress in the office market, but what other value do you see in repositioning these assets?
Well, I'll tell you, I think you're coming back, and again, we're kind of writing my book about developers losing money, and I think that, it's funny, like it doesn't just have to be a conversion. I think that's a misconception too, is that we like to think about kind of the office opportunity set through a couple different lenses, and it's really three overlapping business plans. One is buying office because it's cheap as office. And whether we have a tenant or we think we can lease it, there is a massive amount of inventory of effectively zombie buildings where the equity is underwater, the lender doesn't want to fund TIs or leasing commissions, the original equity certainly doesn't, and they just sit there and they add the vacancy and they're not competitive. And so there's a real play, and some people are doing this, where you can effectively reset the basis, buy buildings out of default, and pursue tenants. And the building that has the ability to perform on TIs and leasing commissions wins. That's one way to look at it. But I think it's hard to say you just do that in a vacuum. And we like to look at always having optionality and alternatives in our business plans. And that's where, like when you talked about National Landing, it was the ability for us to say, I can reduce my supply. So I love that. I love being able to reduce supply. I like to be able to move tenants around, but I also like to have redevelopment upside. And so when we think about office, it's not just office as office. It's office also that can be converted. That's one thing. So sure, we talk about buildings where we can convert a structure. That is risky. That is expensive. That can be challenging. It's a great way to lose money if you don't know what you're doing. And a lot of those conversions, frankly, weren't priced to the point where you would even look at them until now. And it's also challenging because some of those buildings don't have the physical dimensions or qualities that actually make them good conversion candidates. So you really narrow that pool. But you also have kind of the third lens to look at this through is office to residential land, or kind of insert here kind of land that has demand. And so it's sometimes about where can I take an office building offline, and I'm just going to scrape the structure and I'll reuse the parking. So when we look at the opportunity set, we like the fact that it's priced really well, but that we look for opportunities that aren't just one of those lenses. We really like them to overlap on top of each other. Not always, but we like to see stuff where, maybe you could keep, two of the buildings as office, like this Tyson's Dulles deal that you referenced. And one can either become an empty office building for a single tenant who really wants to reposition it. It can be a newly built office building, but it really, like our base case in that example is we're going to get it entitled as multifamily land that's, entitled for wood frame density that can utilize existing garage. It makes it an appealing land site, but we've harvested the tenancy from that and improved the other two office buildings. So we always look at it through multiple lenses of focus, and we don't usually hit the buy button until you sort of see the overlapping Venn diagram between at least two of those three, so that we're always at a place where we feel good about our basis, and our basis enables multiple business plans, and it's in an environment from a zoning perspective or a physical perspective that can allow for multiple business plans. You lose money when you're trapped. When you say, I bought this as office because it's cheap but no tenants show up, even though I can perform on TIs and leasing commissions. Well, if that happens, I better be able to say, hey, I feel good about that basis as land.
Right.
And I'll just use the parking deck. That's my downside protection. Or I end up in a situation where I plan to go redevelop it, and you've got, rates and costs go through the roof. Well, now I have a building that doesn't work as office. It's empty. It has no income on it. I've got carry, and I paid basically a price for an office building that maybe at the time had some income as from tenancy. Once I ride that out, I'm left with something where I have to convert it. But if my conversion math doesn't work, I'm handing that right back to the lender. We don't want to be in those positions.
Right. And you mentioned Tyson's Dulles Plaza. Congratulations, by the way, on that acquisition. Very exciting project. I shared this with you before the podcast, but I repositioned Tyson's Dulles Plaza in 2019 as one of my first projects in the industry, so that has a special place in my heart. They're great buildings, they're well located, There's a great retail scene nearby, but also on site. And as you mentioned, there's a lot of potential for the outdoor spaces to be activated. You have the parking garage. Are there other opportunities in the Northern Virginia area that you're looking at for future development?
Well, first off, I always love about real estate, it is such a small world. I mean, you really can't throw a rock at a real estate convention without hitting someone who's worked on a deal that you've looked at. And, a huge part of what attracted us to that wasn't just the location, the retail, it was the quality, the repositioning. We basically showed up and, shout out to Rockpoint, they did a phenomenal job on those buildings. They amenitized them well, they maintained them well. They did a really good job, and it made it a lot easier for us to believe in the office component of the story. And when you look at all of the amenities that were put in around them, things like pickleball courts, that helps support this, the residential story. And so we really do think like that was a super well executed project. So nice job on that one. And, I think there are a lot of opportunities like that. I spend a lot of my time, and my team, George and I, are out there constantly pounding the pavement, looking for other opportunities that fit those lenses, because I think there is a lot of opportunity to do this. And I think part of that, you mentioned Northern Virginia, is just driven by the fact that, whatever else is happening in the world, there's $1 trillion defense budget. And that, for defense, homeland security, intelligence, there is a strong location quotient to that in Northern Virginia. And I think that creates a demand environment that you feel better about for certain kinds of spaces, but you still have to be super selective about where you go.
Well said. Just south of National Landing in Potomac Yards, JBG Smith currently has several parcels in the entitlement phase, including plans for roughly 750 new homes across multifamily and townhomes, a land donation for an 88-unit affordable building, and added ground floor retail tied to the Potomac Yard Metro Station. National Landing has shown how you can use placemaking, transit connectivity, and smart infrastructure to transform an area anchored by major tenants. Do you see Potomac Yard as an opportunity to replicate and adapt the strategies that you executed at National Landing? What might you do the same, and how would you approach differently based on your lessons learned?
So first off, Potomac Yard is part of National Landing. So when we think about it as though, National Landing is Pentagon City, Crystal City, and Potomac Yard. Right. Pentagon City, we sold a lot of our land holdings there to Amazon to build HQ2 for them. We also have significant multifamily in that market. And Crystal City is kind of the office core. So think of it almost, if you were to imagine it, it's on a big scale, but take it down to a small scale. It's like owning, an office park that's maybe mixed-use office park that has an apartment building. It's got a user campus, and it's got a bunch of smaller office buildings. And then there's a vacant lot. That vacant lot, in a lot of ways, is Potomac Yard. So we think about it kind of like the last phase or other phase of the project, because it's the part that it's not urban infill, it's more greenfield. Mm-hmm. And so what Potomac Yard does and offers, which is really interesting, and you mentioned some recent entitlements, and we should talk about why that matters. But if you look at Potomac Yard, be remiss to ignore the fact that, for a while we were actively involved and have been selected to be the new home of the Wizards and the Capitals. And, a lot of sports fans say, I don't like that move. I don't like that move. There was a very contentious political process and ultimately didn't go our way for a lot of different reasons. But one of the things it did was that it showed, why did they choose Potomac Yard? Why there? Well, it's the biggest piece of undeveloped land that's inside the Beltway in DC that's got Metro. Mm-hmm. And so we had sort of said, look, there's something that's going to go there. Virginia Tech went there. It was a great way to basically have the land to create the Virginia Tech Innovation Campus. They're an anchor there. So you have the Innovation Campus, you have the new Metro that just delivered. Those two things are huge. Mm-hmm. We're activating part of the site with the wood frame apartments and townhomes, and got to give a shout out to our development team, led by, Taylor Lotch and Matt Ginnivan, who spent a lot of time programming that site, but they worked really hard with another really creative jurisdiction with Alexandria, who had a lot of that entitled for different things. Mm-hmm. And they were able to see, hey, this doesn't make sense anymore to have big GSA office sites and, concrete high-rise buildings that wasn't buildable, and there's a need for housing. So they were really smart about working with our team to come up with some really neat mixed-use housing typologies that fit in well, that anchor there. But we're also still preserving this big component of Potomac Yard because we think it's a perfect anchor location for something big and special in Greenfield. Because when you think about, what putting a sports arena there would have done, and that sports arena had a music venue and things associated with it, that site is the missing piece for the other big anchor. Mm-hmm. And so I think what we'll do is we'll continue to entitle and develop around it and take advantage of it, but really try to preserve that opportunity to do something transformative there, like that arena would have been, because there are other groups out there that want to be close into DC that, won't fit in Crystal City. We have some ground up development that's exciting. We have some conversions that you talked about. But if I want to go build whether it's a big venue of some kind or whether it's a large campus, there aren't that many places to do it. That's kind of the opportunity.
And I think it speaks to JBG Smith's ability to pivot and not rely on a single anchor tenant. In this case, it would have been Monumental Sports, supported by others. But I think that speaks to how you guys were able to move on and come up with another plan to make that space special.
I think, look, the reality was we had no idea that Monumental was going to turn up. And that came out of a dinner party conversation. Wow. Which is really interesting that people were musing on. And it was like, well, wait, don't you have this big piece of land here? Can't you do something with it? They'd originally talked about a different piece of land that didn't work for that, but these things happen. And I think you're right. That ability to pivot is important. But more than that, it was also the way that deal was structured. I mean, our partner there is a pension fund who owns the shopping center. And we don't own any part of the shopping center. We put a joint venture together that contributed the land next to Virginia Tech and this 50-50 JV with some other land that we own. But we were super selective about, look, we don't own the shopping center. We'll help you plan it. We'll manage it, do things like that. But we don't need to roll it all into one giant joint venture that would then, create some, potential conflicts or challenges for us kind of holding things long term. It was really about how do we structure a deal that gives us the most optionality and flexibility to bite things off, to develop them. And we've been doing that. Our involvement in Potomac Yard goes back to the mid-2000s. We've accessed and developed a number of sites there over the years, but we've done it in a way where we're not like biting off something that doesn't have income that, for our time frame at the time as a private company and our cost of capital would have just sat fallow. It really came back to, can we structure this in a way where the right owner has the right things and we can use that to unlock development opportunity that gives us the flexibility to pivot. That's our hallmark. If I were to say there's anything, it's like the ability to structure those deals in that way.
Absolutely. For what it's worth, I'm a resident of Alexandria City, and I was fully behind your plan in Potomac Yards. My wife, on the other hand, not so much, but I'm excited for what is going to come. A lot of divided households. That's only a healthy thing. JBG Smith has returned more than $1 billion to shareholders through buybacks, while the stock trades well below what many believe is its true value. Does that reflect leadership's confidence in the company's strategy and belief that the market will eventually close the NAV gap? And what gives you optimism about the long-term value creation for shareholders?
Yeah, I think you put it really well there. And it comes back to kind of my earlier comments, just starting out, that so much of what we do is built around making the right value decisions and weighing investment alternatives. And for us, as we bought back stock, it was because ultimately we looked at the value of the stock, the implied value of the office in particular in there, and said, look, we're getting a great deal. And is this a better deal at the time than going out and buying office in the market? Yeah, it was the cheapest way to access. People used to talk about why aren't you doing distressed office? It seems like the kind of JBG contrarian bet. It's like, no, we are. We're buying our own. It's not distressed, but we're buying it because it was cheap. And we did have belief. We do still have belief ultimately. So all of us, our leadership team, the vast majority of our collective net worth is tied up in this thing. We really believe in it. We're have really high insider ownership percentage because we all, I think, collectively see there's a lot of value here. And so when there was an opportunity to recycle capital out of things that we felt were fairly priced in the market and buy something that was really, really inexpensive, that was what we did, because we're always thinking about generating that maximum NAV per share accretion to our shareholders. That's what we do. And it comes from being very value focused, being very real estate focused in our investment strategy. And what you've seen, is our stock prices, after being at that bottom and being a great buying opportunity, we've seen it, run up pretty dramatically. And I think when you talk about closing the gap to NAV, who knows? I don't think we're there yet, but there's a point where, when we were trading at NAV back in, call it 2018, we issued equity and we used that to grow. And so we're always looking at what's the best source of capital for growth and where are there great buying opportunities and where can we leverage sort of deltas in market pricing to create kind of an asymmetrical risk-adjusted return. And that's what we're doing when you see us make decisions like buying shares, but also buying distressed office. It all comes back to that same thought process and mentality and a belief in our skill sets and a belief in our capital allocation abilities.
We've talked a lot about JBG Smith, how you're innovating, how your strategy has created these vibrant urban ecosystems. What other groups, domestically or internationally, are you watching closely, and who would you recommend that we also take a look at?
Oh man, there's so many really, really interesting groups out there who are doing creative things. I think that, look, on the office side, People are making contrarian bets every day on a very small scale. They might be independent sponsors. They might be people who have really good ideas or really detailed kind of close in tenant knowledge. So I think there are a lot of groups out there. I'd say some really good mixed use developers who might not get the attention or credit they deserve. Everyone could talk about some of the big REITs, but one in particular is a group called Insight, in the DC market. I think they do incredible work. And, Trent Smith, who's a partner there, has been able to figure out some really, really exciting opportunities to unlock and, blending high quality mixed use development with opportunistic site acquisition. They're doing a redevelopment of an office heavy site in Fairfax that I think will be one of the neatest things we've seen. You look at, this is a group that's obviously much larger, but what Eden's has been able to do in our market, I think, is a bellwether for placemaking and probably the gold standard when you think about not only, Union Market, where we're also investors in that neighborhood, but also looking out at, what they've done in Mosaic District in Fairfax. And I like to point at that one, okay, Union Market, great, makes sense, exciting, really cool urban neighborhood. Nobody looked at Mosaic and said, wow, this will be this anchor for Fairfax County next to Tyson's Corner. It's become, honestly, one of the most vibrant parts of that ecosystem, but it did it in a suburban strip mall. And they did it in the right way, where they created demand for office, for multifamily, and they bought distress. They bought something nobody else wanted. So I'd say that those groups are doing really interesting stuff. And I'd say, like, both on the small and the large side, they're kind of the preeminent placemakers. One other, shout out I would give is just thinking about some of the really niche and specialty groups, like what COPT has done. We talk a lot about our, concentration around national security, and that's something where I spent a lot of my time, quite frankly. But you've also seen, groups become really specialized. And COPT, from an office perspective, their office portfolio does really well. And they've been really thoughtful about knowing their niche and not trying to be everything to everybody, but buying and developing office in a really stable, thoughtful, specialized component of the market. So, I'll shout out, Britt Snyder, who's their COO, former colleague of mine from JBG Smith, who's helping them continue to sort of scale and evolve that platform. So those are kind of three groups I'd tell you to spend time with.
All great groups. I'm glad that you shared that. Evan, I want to thank you for coming on the podcast today and for taking the time to come visit the Center for Real Estate in person. I'm hoping that you're enjoying your time here. We're really looking forward to your lecture later this evening. Very excited about that.
All right. Well, thank you so much for having me. Looking forward to it and happy to be able to participate here. Thanks so much.
Yeah, absolutely. To our listeners, thank you for tuning in to this episode of the Meet the Visionaries podcast. And be sure to tune in to some of our upcoming episodes, as we have some very exciting guests slated for this fall. I'm Michael Khamis, and I'll see you next time at the MIT Center for Real Estate.